Gambling.com represents one of the most compelling deep value plays in today's market, particularly within the rapidly evolving sectors of prediction markets and United States gambling growth. Despite a remarkable operational performance, the disconnect between price and intrinsic value remains staggering. Since 2021, GAMB has sextupled EBITDA and quadrupled revenue. Yet its share price today trades at roughly one-third of its 2021 highs. This anomaly becomes even more pronounced when considering that the company currently trades at approximately 3 times forward EBITDA, a valuation virtually unheard of for a growing enterprise with durable recurring subscription revenue accounting for more than 50% of total revenue. The recent GAAP earnings dip, driven by a non-cash recognition of upcoming bonus payments, obscures the underlying strength of the business. This accounting quirk stems from the explosive approximately 100% year-over-year success of GAM's odds data acquisition business, which now serves as the primary source of sports odds and bet settlement for prediction market leaders Kalshi and Polymarket. The rise of prediction markets has unlocked sports betting access for 18 to 21-year-olds and in states where traditional online sports betting remains illegal, creating a new growth frontier for GAMB. While charts would illustrate this disconnect vividly, the fundamentals alone tell a compelling story. From a valuation perspective, GAM's total enterprise value to unlevered free cash flow ratio sits at an astonishingly low 4.7 times, with a DDI of 0.11 times, metrics that barely edge out Palantir's eye-catching EV/FCF multiple of 342 times. This stark contrast underscores the market's mispricing of GAMB relative to peers. The company's core affiliate segment, which accounts for 75% of revenue, continues to deliver robust margins, while its data services segment, currently 25% of revenue, is growing at a blistering pace and is projected to surpass the affiliate segment in top-line contribution as early as the second half of 2026. OpticOdds, the B2B engine of the data services segment, exemplifies this growth trajectory, posting a jaw-dropping 304% quarter-over-quarter revenue increase in the third quarter of 2025. These long-term contracts with sportsbooks and media outlets enhance revenue reliability and position GAMB for sustained expansion. As CEO Charles Gillespie noted during the third quarter 2025 earnings call, given the long runway we have for consistent growth in our sports data services business, we believe that this exciting future will be the core of GAMB. The affiliate marketing arm remains a cash cow, leveraging more than 50 high-authority websites to connect gamblers with second- and third-tier online casinos and sportsbooks at gross margins exceeding 90%. With negligible fixed costs, limited to domain renewals and hosting fees, this segment has scaled revenue by over 900% in 7 years, while maintaining enviable margins. Importantly, GAMB has mitigated regulatory risk and capital intensity, distinguishing itself from competitors burdened by compliance and infrastructure costs. Despite these strengths, valuation multiples such as price to sales and EV/FCF have compressed, defying logic and reality. Management's strategic diversification beyond SEO dependency further fortifies the business model. By expanding into email, social media, and revenue-sharing partnerships with major platforms like USA Today, GAMB anticipates generating more revenue from non-SEO channels than SEO for the first time in the fourth quarter, a milestone Gillespie highlighted in the third quarter earnings call. Complementing this diversification are 3 acquisitions: Spotlight.Vegas, RotoWire, and Odds Holdings, parent of OpticOdds and OddsJam. Of these, OpticOdds stands out as a transformative addition, evolving into a comprehensive platform offering bet acceptance, settlement, and risk management for small and mid-sized sportsbooks. The January 2025 acquisition, structured as $80 million upfront and $80 million in performance-based earnouts, has already exceeded expectations, with management projecting full earnout payouts thanks to revenue doubling this year. Nevertheless, the market reacted irrationally to a non-cash accounting expense tied to earnout revaluation, triggering a 23% single-day share price plunge from $6.84 to $5.25, followed by a 52-week low of $4.60. This knee-jerk response ignored record revenue and operational strength, presenting a rare opportunity to acquire a thriving business at a depressed valuation. Consider that GAM's 2025 acquisitions collectively exceed its current market cap, a testament to the disconnect between enterprise value and market perception. As 2025 concludes, management guides for fourth quarter revenue of $46 million and EBITDA of $15.41 million, bringing full-year figures to $165.2 million in revenue and $51.7 million in EBITDA, up from $127 million and $41.4 million in 2024. CFO Elias Mark projects 2026 revenue growth of approximately 14% and EBITDA margins of approximately 33.5%, implying $188.3 million in revenue and $63 million in EBITDA, a 21.8% year-over-year EBITDA increase. These metrics hardly describe a business in decline. With $15 million allocated for share repurchases and a modest debt load, GAM retains flexibility to enhance shareholder value. Critics often caution against acquisition-driven growth, yet Gillespie's track record suggests disciplined capital allocation. Odds Holdings has unlocked a high-margin, recurring revenue stream growing at triple-digit rates, complementing organic affiliate growth that averaged 50% annually from 2017 to 2024. While affiliate growth slowed to 2% in 2024 amid Google algorithm volatility, management's pivot toward diversified channels mitigates this risk. Furthermore, binary state-level legalization events remain unpriced catalysts, with major markets like California, Texas, and Georgia, representing 124 million people, still offline. The potential elimination of taxes on gambling winnings floated by Trump adds speculative upside, though regulatory tailwinds alone justify optimism. In 2024, the Americas contributed $55 million of GAM's $127 million revenue, a figure poised to surge as United States legalization accelerates. For long-term investors, prolonged undervaluation enables accretive buybacks, compounding EPS growth, a dynamic Gillespie appears keen to exploit. Management alignment and ethics further bolster the investment thesis. Stock-based compensation, SBC, while rising 3.5 times since IPO, remains proportionate at approximately 4% of revenue and is outpaced by free cash flow growth, which has quadrupled since 2021. Dilution risk is minimal, with share count stability and limited equity issuance for acquisitions. Insider ownership remains robust, with Gillespie and co-founder Mark Blandford maintaining significant stakes. Notably, Gillespie recently increased his holdings to over 11%. These signals, coupled with prudent early earn-out payments and consistent buyback activity, reflect a shareholder-friendly posture. Risks, of course, persist. The Swish Analytics lawsuit introduces uncertainty, though indemnification provisions and set-off rights likely cap financial exposure. More existentially, AI-driven disruption of search threatens affiliate economics, yet Google's resilient ad revenue and vested interest in search integrity suggest a gradual, not abrupt, transition. Prediction markets, while cannibalistic to traditional sportsbooks, expand the overall addressable market, particularly among younger demographics and in states where online sports betting remains prohibited. GAM's integration with Kalshi and Polymarket positions it to capitalize on this trend via both affiliate funnels and data services. While prediction markets' zero-sum mechanics limit OpticOdds' risk management utility, opportunities in bet settlement and micro-market expansion remain. Importantly, OpticOdds already serves as the primary sports data partner for Kalshi and Polymarket, as well as powering offerings for Robinhood and Coinbase, relationships that could deepen as prediction markets scale. In conclusion, GAM epitomizes the essence of value investing, a misunderstood, underappreciated business with robust fundamentals, multiple growth levers, and a fortress-like margin of safety. With consistent double-digit revenue and free cash flow growth, recurring revenue streams, strategic acquisitions, and regulatory tailwinds, GAM should command a premium multiple, not languish at 3 times forward EBITDA. My base case discounted cash flow assigns a fair value of $20.58 per share, assuming conservative growth and margin assumptions, implying a 7 times upside. Even under adverse scenarios, intrinsic value dwarfs current pricing. While operational execution and external risks warrant vigilance, the asymmetry here is extraordinary. For investors willing to embrace complexity and volatility, GAMB offers a rare opportunity to compound wealth in an industry poised for secular expansion. The market's fixation on transient headwinds, algorithm tweaks, accounting noise, and speculative AI fears obscures the durable competitive advantages and strategic positioning that define GAM's future. As prediction markets proliferate, state legalizations accelerate, and data services outpace legacy affiliates, the narrative will shift. Until then, patient capital stands to reap outsized rewards from a business trading as though it were dying, when in reality it is thriving.